Let's discuss a big sector, oil and gas. Amit Rustagi, Vice President, Energy Research at Antique Stock Broking, now joins us. Amit, hi, morning. Good to have you on the show. First, a word on the subsidy bombshell that the government had in store for both ONGC and Oil India. I mean, market had a bit of fear that something like that would happen. But do you think the market is a bit sanguine about this, considering that in FY16 maybe there would be a new formula? Or do you think it's time to actually sell these stocks, both ONGC and Oil India?
See, if we look at the stocks and the bombshell which government has put on these companies, the clear-cut message is that despite reduction in the under-recoveries, the companies like ONGC and Oil India are not going to benefit. So we have to see whether government will provide a clarity to the to the investors, and minority shareholders are at the receiving end in these companies particularly, and they have been getting shocked quarter on quarter, because this quarter we had seen the lowest under recovery of INR 160 billion, and despite that upstream companies had the highest sharing of 68%, and the net realizations of these companies were at the lowest of $35 to $38. So which was quite shocking for the investors, and investors want a sustainable sharing mechanism, and so that they can take a call on the earnings of these companies, which is not being provided by the government. And so there is no clarity whether FY16 we continue with the ad hoc mechanism or government will provide a sharing clarity. So I think till that time investors should stay away from these stocks, and probably Oil India is still slightly safer bet as compared to earnings and multiples, but ONGC, because of its oil exposure in the form of cane and OVL, is likely to take a earnings hit in the year to come, as oil prices are averaging $60. So we see that it is trading at around 12x multiple to next year earnings, which is slightly expensive related to its historical multiples. So we will suggest that investors should move from, if they want to take a bet on the PSU upstream, they should move to Oil India rather than ONGC. But till the time clarity comes, it's beneficial to stay away from these stocks.
Okay. Amit, how did you read the numbers of BPCL, HPCL and IOC? And now that we're seeing Brent crude prices tick higher, how would it change your numbers that we could see in Q4 versus Q3?
Yeah. So basically, when you look at oil marketing companies, they have been an interesting play on the marketing side of the business as well as on the refining side of the business. Last 1 year we have seen markets have been remaining focused on the marketing side, but inventory at the refining side and the marketing side was quite a big bit of concern. So this year, last 2 quarters, we have seen these companies together reporting a loss of almost INR 150 to 180 billion in terms of inventory losses, as they corrected their inventory levels to the realigned to the crude level of around $45 to $50. Now oil prices being going up or moved up to $60 per barrel, the inventory losses are a thing of past. So Q3 earnings we have seen is likely the bottom of these companies. From Q4 onwards, the refining margins are likely to recover. There won't be any inventory losses going forward, or in fact there will be inventory gains, and marketing earnings are quite robust for these companies because they have been able to take the price hikes at the adequate time. So this time also on the 15th, they have increased the prices of petrol and diesel to sustain their marketing margins on these two regulated commodities. So when we look at these factors together, next year we are going to see a significant jump in the earnings for companies like HPCL, BPCL and IOCL, largely driven by improved refining margins, sustainable marketing margins at the regulated products, and sustainable inventory gains, and basically stable rupee. Okay. So when we put all these factors into consideration, we have a buy on BPCL with a target price of 1,000 rupees, HPCL with a target price of 880 rupees, and IOCL with a target price of 475 rupees, which leaves almost 30 to 50% upside from the current levels due to recovery in the earnings.
Okay, Amit, you were among the first to downgrade GAIL, and that call has actually played out quite well. But after the kind of underperformance we have seen, Do you think GAIL is still overvalued? Or do you think if it's taken out of subsidy net, maybe that could lead to a bit of minor re-rating? How would you be positioned on this one now?
Yes, so I think as I said initially that government has not given any clarity on the sharing mechanism. So this quarter can be just aberration where GAIL has been taken out of the sharing mechanism, and whenever the earnings recover for GAIL, GAIL might be put back to the sharing mechanism again. So I think we are not going to take a big call on the stock as of now, but looking at the fundamentals, we continue to see that petrochemical prices are still declining. LPG prices are still at the lower end. So these two commodities or these two segments form roughly 65% of the profitability of the company, which is still under pressure. So I think we are going to see further de-rating in the stock from the current levels. Whatever positiveness is being there, that is just because for the third quarter GAIL has been taken out of the sharing mechanism, but we are not seeing any sustainable recovery in the two segments which are determining 65% of the profit of the company. And going forward, as we have highlighted for Petronet LNG as well, GAIL is having long-term contracted LNG from Petronet, which is coming at the highest price of $13.5 to $14 versus spot LNG prices of $7 to $8. So I think they are facing a lot of challenge on that front, that how to accommodate the higher priced gas with the consumers. So last quarter also we have seen around 95 crore loss in the marketing segment, which might continue in the fourth quarter as well. So I think when we estimate the earnings are likely to remain much weaker for GAIL in the fourth quarter and the years to come. Okay. Unless we see oil prices recovering back to $80 to $90.
Okay. Amit, can you tell us about your calls on Cairn? What is your call on Cairn, maybe in a rising Brent crude scenario? What you're envisaging in terms of Brent crude prices as well? And additionally, your call on Reliance?
Yeah. So we have a Brent price assumption of $60 for FY16 and $70 for FY17. And if we see oil prices are near to that levels, only around $60. But if you look at the sustainability of oil prices at these levels, looks difficult looking at the global supplies. US supplies are still rising, and in the summers we are going to see more supplies coming from US shale gas, and hence oil prices are likely to remain under pressure between $50 to $60. So now when we priced in $60 and $70 for cane, we get a target price of 195 rupees based on the assumption that they are going to cut back on the capex going forward, which is going to challenge the production recovery or production growth from the current levels. So for E&P companies, two factors, as we have said earlier, are the most important. One is the volume growth and the pricing. So both of them are under pressure and are likely to remain under pressure for next 1.5 to 2 years, and hence we have a sell rating on the stock with a target price of 195.
Okay.
And coming to Reliance, we have a buy rating. As I said, that refining margins are recovering for the sector, and Reliance 60-65% of the earnings are still derived from the refining segment. So in the quarter to come, we are going to see a improved earning outlook for the company, and we are going to see fourth quarter GRMs improving to between $9 to $10 going in the coming quarter, and hence we have a buy on the stock with a target price of 1045.
Fair enough, Amit. Any disclosures you'd like to leave us with?